The problem Silicon Valley Bank faces today is very different than the 2007 to 2009 banking crisis. SVB was thriving. Credit losses are fairly low. Its deposits tripled from 2019 to 2021. How's that a problem? It sounds great, right? Well, it's a wonderful life. When banks accept deposits from clients, they owe the client that money. So deposits are liabilities to the bank. Liabilities cost money. To pay for the cost of those liabilities, banks turn them into assets, lending deposits as small business loans, mortgages, etc. If a bank can't lend deposits responsibly, it often uses the excess to buy loans or securities, like US Treasuries and mortgage-backed securities. As mentioned above, from 2019 to 2021, the deposits at SVB tripled. That's a good, but tough, problem. Banks need deposits, but they cost banks money. Banks need to lend deposits to cover the cost. Silicon Valley Bank needed to take those funds and acquire assets to pay its costs. SVB knew it couldn't lend those responsibly. It was too much, too fast. Much of the money was from VC-backed companies that needed a place to deposit the cash they raised. Those are big deposits. Keep in mind the FDIC only insures $250,000 per customer per bank. Deposits were pouring in too fast to lend responsibly. SVB recognized that. Rather than make dumb loans, SVB bought assets guaranteed by the US government, treasuries and MBS. But it bought long-duration assets, often 10-plus-year bonds. When rates rise, fixed income prices fall. A general rule of thumb is for every 1 year of duration, each 1% interest rate move impacts the price of the bond by 1% times the duration. For example, a 1% interest rate move up on a 9-year duration bond is 9% move down on the bond price. But banks are levered. Remember, banks generally acquire assets by using deposits as the capital source. And banks like SVB are levered 10 times or more, owing $10 for every $1 of shareholder equity. If you're levered 10 times, a 10% loss on assets is a 100% wipeout. So SVB bought high-quality assets, but it bought tons of them with long duration at low interest rates. When the Fed raised rates to fight inflation, those assets declined in value. Those losses, multiplied through the leverage, caused a big problem. SVB now has a mark-to-market hole in its balance sheet. But it's not taking loan losses like subprime defaults. It's mark-to-market. As long as its liabilities are sticky, i.e., depositors leave their money at SVB, it will ultimately be fine. But that's a big assumption. Technically, if all the depositors ask for their money back at once, SVB needs to sell those bonds at the mark-to-market value, crystallizing what could have been a temporary loss. And if those losses are big enough, SVB may not have enough money to pay out all depositors. But that situation rarely happens. However, once it starts, game theory kicks in. Nobody wants to be the last depositor at a bank. We all can picture what happens. What's next? Well, there are a few possible scenarios to consider. In the first scenario, all deposits are guaranteed and the crisis can be contained. However, this might create moral hazard and encourage excessive risk-taking. The second scenario involves letting the market force play its role. This would mean that the assets of SVB would be sold to either the government or private sector, and the proceeds would be paid to uninsured depositors. These two scenarios would have very different impacts on risk appetite and the equity market in the short term. The first scenario would likely result in a quick market recovery, whereas the second scenario would likely lead to loss of confidence and further market sell-off. During the weekend, it is also reported that regulators are discussing to set up fund to back up deposits if more banks fail. Let's wait and see what will happen next week.